All right, let's be real for a second. If you've been paying any attention to the markets for the last, 15 years,
At least
your job has been incredibly simple. You had one job, really.
one job
Buy the future.
in big, bright neon letters.
Exactly. You buy software, you buy the cloud, you buy AI, and you know what? It worked. It worked phenomenally well.
Oh, it was a spectacular run.
We've been in this golden era where the S&P 500, it basically just became a tech index.
It did.
It felt like code could solve any problem. Like, why worry about physical things? Why worry about digging rocks out of the ground when you can just write an algorithm to optimize it away? It's been the age of the tech bull, and honestly, we've been winning.
It has been the winning strategy. I'm not here to deny that. But while everyone was glued to those stock charts, watching them scream to all-time highs.
The digital confetti falling, right?
Exactly. While that was happening, something else was going on, or maybe more accurately, something wasn't happening.
I feel a very large butt coming.
Yeah.
Very heavy butt.
It's more of a, let's call it a noir reality check.
Okay.
While we were all celebrating the digital world, the smart money, and I mean the really big long-term capital, they saw this terrifying signal blinking red in the physical world.
A signal. What kind of signal?
The foundation is cracked.
The foundation of the economy.
The literal physical foundation, the stuff, the metal, the energy, the materials. We just stopped building it. We stopped looking for it.
And now?
And now we're staring down the barrel of a $10 trillion rotation. At least.
10 trillion.
Capital is beginning to flee what we call paper assets, tech stocks, the hype, all of it, and it's moving into hard assets.
Gold, copper, oil.
Gold, copper, oil, uranium,
Right.
the real stuff.
So the whole argument here is that the old economy, the stuff we thought we left behind in the 20th century, the dirty industrial part,
Yeah.
it's about to take its revenge on the new economy.
That's it in a nutshell. We are entering what's known as a commodity supercycle, and the stakes couldn't be higher. The era of easy tech gains. It's over.
And the era of scarcity has begun.
It has.
Okay, let's unpack that,
Yeah.
because scarcity feels like an old-fashioned word. We have AI that can create infinite content. We're used to digital abundance, but you're talking about atoms, not bits.
Atoms, not bits.
So what's the core of this? Why is this happening now?
It all starts with a concept called CapEx starvation.
CapEx, capital expenditure.
Right. It's just the money companies spend to find new resources, to build new mines, to drill new wells. It's the investment in future supply.
And we stopped investing.
To really see it, you have to look at this one specific chart. In the industry, they call it the alligator jaw.
The alligator jaw. Okay, I like a good visual metaphor. Paint me
Right.
the picture.
All right, imagine a chart. It starts around 2011. You have two lines. There's a green line, and that's technology investment.
Okay.
Since 2011, that green line has, it's gone vertical to the moon. Trillions poured into apps, software, streaming, and now, of course, AI.
Sure, that makes sense. That's where all the growth was. It's where the venture capital flowed.
Now, look at the red line. That line is mining and physical industry investment.
And that one went down.
It didn't just go down, it crashed, it went to zero. In real inflation-adjusted terms, you could argue it's been negative in some sectors.
Wow.
So you have tech spending going straight up and resource spending going straight down, and they diverge so sharply, so fast, it looks just like an alligator opening its jaws.
And the gap, the empty space between the jaws.
That gap is the deficit. That's the opportunity. It's the physical hole we've dug for ourselves and the raw materials we need to actually run the world.
But I don't get it. Why did it crash? Capitalism is supposed to be efficient, right? If we need stuff, doesn't the market just dig more holes? If there's demand, why did the investment just stop?
Because we didn't think we needed it. You have to rewind to the boardroom psychology from 2011 to 2015.
Right.
Remember, we'd just come off that huge commodity boom in the 2000s, all driven by China's industrialization.
Right.
But then that cooled. Commodity prices crashed. And Wall Street effectively gave all the mining CEOs a new mandate. They said, stop.
Just stop digging.
They told them, don't you dare spend $1 on exploration. Don't dig a new hole. We don't want projects that might pay off in 10 years. We want you to take every spare dollar you have and buy back your own stock.
The short-term sugar rush. Boost the stock price this quarter.
And worry about the copper supply next decade.
So the CEOs listened.
They did. They slashed exploration budgets to the bone. They fired their geologists. They shut down drilling rigs. They scrapped plans for new mines. Efficiency became the new god.
But But isn't efficiency good? I'm wearing my tech bull hat here, and efficiency is what we live for.
Efficiency is great, don't get me wrong. But in the world of physical resources, starvation is fatal.
Fatal how? Are we just talking about a temporary dip in supply?
We're talking about the death of discovery.
The death of discovery.
Let this sink in. We have not discovered a major world-class Tier 1 copper mine in 15 years.
15 years.
Nothing. Think about that. The entire global economy is running on the fumes of discoveries made back in the 90s and the early 2000s. We are literally eating the seed corn.
Okay, but again, devil's advocate. Technology moves so fast. If the price of copper suddenly shoots up tomorrow because we're running low, won't these companies just, flip a switch and start digging again? The market reacts. High prices cure high prices.
And that right there is the trap. That is the assumption that gets the tech-focused investor absolutely killed.
How so?
You are applying software speed to geological time. And this brings us to what we call the supply air pocket.
The supply air pocket. That sounds bad.
It should. It's terrifying. In software, if you need more capacity, what do? You spin up another server on AWS.
Takes minutes.
Minutes. In mining, from the day you discover a deposit to the day you produce your first pound of copper, it takes 15 years.
To 15. Why so long?
It's just physics and bureaucracy. First, you have to find it. Then you have to delineate it, which means drilling thousands of holes to prove it's big enough. Then you have to get the permits.
Which takes longer than ever.
Longer than ever because nobody wants a mine in their backyard. Then you have to build the infrastructure, the roads, the power, the water, usually in the middle of nowhere. And then finally, you can start digging.
So if we decide today, right now, that we are in a copper crisis.
That new supply does not arrive until 2040.
Wow. Okay, so the shortage is already baked in. The cake is in the oven.
We are walking right now into a period where demand is about to go vertical, and we'll get to why in a second. But supply is completely, totally inelastic. It can't stretch.
So the warehouses are empty?
The warehouses are effectively empty. We are approaching what they call zero inventory in key industrial metals.
That's a sobering thought. Zero inventory. It sounds like something from a post-apocalyptic movie.
It's where we're heading.
But let me push back on this a bit more. We're smarter now, right? We have AI. We have green energy. We are becoming more efficient. Doesn't this whole green future mean we stop relying on all this dirty old economy digging? Aren't we moving past the age of the rock?
That is the single biggest misconception on the market today.
Okay.
And it leads us directly to our next major point, the green paradox.
The green paradox.
A paradox is this. The very people who, for good reason, hate mining, the environmentalists, the policymakers pushing for net zero, they're the ones driving the single biggest demand shock for mining in human history.
You can't have one without the other.
You cannot have a green future without a massive, unprecedented amount of dirty industrial mining.
It's the hardware. You have to connect the tech to the dirt.
Exactly. Let's just look at the data points. Take an electric vehicle. You love EVs, right?
Of course. They're sleek, silent, fast. Feels like you're driving an iPhone.
An EV uses 4 times as much copper as a regular gas car.
4 times.
4 times. It's essentially a copper coil on wheels.
That's a lot of wiring.
It's the motors, the batteries, the charging infrastructure. Now look at renewables, wind farms, solar panels. These aren't just, magical beams of light.
Right.
A single wind turbine requires a massive tonnage of steel, of copper, of rare earth metals. The material intensity to generate 1 megawatt of wind power is dramatically higher than a natural gas plant.
So in our quest to save the planet, we actually have to dig up more of it.
Much, much more. But here's the real kicker. This is the one that really blows up the whole tech solves everything argument.
Let me guess. AI.
AI.
Oh, come on. Don't tell me AI is part of this too. AI is just code. It's in the cloud. It's the ultimate intangible.
But what is the cloud?
It's a data center.
It's a data center. It's a massive concrete building packed with servers, and those servers get very, very hot.
I've heard about the energy usage, but is it really enough to move the needle on a global scale?
It's staggering. A single large AI data center consumes the same amount of electricity as a small city.
A whole city.
We are talking about utility-scale power demand, and you can't run that on intermittent wind that might stop blowing. You need constant baseload power. That means natural gas, that means nuclear, and all of that electricity has to be transmitted through what?
Copper wires.
Through copper wires, through transformers. The entire electrical grid of the Western world needs to be rebuilt and upgraded just to handle the AI load.
So the mental image is...
I like to picture it like this. You have this sleek, futuristic Tesla, or this glowing server farm humming with AI. It looks like it's floating in the future.
Right.
But if you follow the power cord, that machine is tethered to a giant heavy anchor made of raw ore. It cannot move. It cannot function without the physical inputs from the ground.
The future is tethered to the ground. That's a powerful image.
That's the reality. The future economy is incredibly hungry for the old economy. You can't print copper.
You cannot code uranium?
Exactly. And because of that decade of CapEx starvation we talked about, we are now heading for a violent collision.
Record demand meets 10 years of underinvestment.
And when those two forces collide...
Explosive price action. It's just economics 101. When supply is fixed and demand explodes, price is the only thing that can give.
That's barrel one of the shotgun.
Okay, so that covers the supply and demand, the physical side. But you mentioned a second engine for this supercycle, something more macro.
Yes. If the supply shortage is the fire, this is the gasoline. We have to shift from industrial physics, the rocks and the mines.
To monetary physics?
To monetary physics, we have to talk about the dollar, and we have to talk about the debt.
Okay, lay it on me. I know the debt numbers are huge, but they're so big they almost feel meaningless. It's like monopoly money.
Let's make it concrete then. Right now, the U.S. government is adding $1 trillion in new debt every 100 days.
Every 100 days. That's sustainable.
It is demonstrably not sustainable, but it is happening. This is what's called fiscal dominance.
Meaning the debt is now driving the policy.
The interest payments on the debt are becoming the biggest line item in the budget. And there's only one way a government can manage that kind of debt load, eventually.
They print the money.
They print the money to pay the bills, they monetize the debt, and that leads directly to currency debasement.
Which is just a fancy term for inflation.
It's a very specific kind of inflation. It's the devaluation of the paper money itself. When you print trillions of new dollars, the value of each dollar has to fall against things that are finite.
Finite things.
Like gold. Gold, copper, oil, land, art, anything that can't be created with a keystroke. And this is why you have to watch the central banks. They are the ultimate smart money. They see the real balance sheets. And do you know what they did in 2024?
I have a feeling they weren't buying tech stocks.
They bought more physical gold than at any other time in recorded history.
Wow.
Central banks, China, Poland, Turkey, Singapore, they're all loading up. And they're not speculating. This isn't a trade for them.
It's a hedge.
It's a hedge. They are actively trading their fiat promises, their paper money, for physical reality.
They're swapping the paper for the rock.
That's it. And this creates what I call the double-barreled shotgun effect for commodities.
Explain that.
Okay, barrel one is the physical shortage we just talked about. We don't have enough copper for the EVs and the AI data centers, so the price goes up based on simple supply and demand.
Got it.
Barrel two is the currency devaluation. Even if we magically found a giant new copper mine tomorrow, if the dollar loses 20% of its purchasing power because of all the money printing, the price of copper, which is priced in dollars, has to automatically reprice 20% higher just to stand still.
So heads, commodities win because of the shortage.
And tails, commodities win because of inflation.
It's an inflation hedge that also has this huge supply-demand tailwind.
Exactly. If you hold the physical asset, you are protected from the printing press.
Okay, you've convinced me. Let's say I'm on board. I'm scared of the debt. I see the empty warehouses. I want in on this revenge of the old economy. How do I actually do it? Do I, go buy a bunch of copper bars and stick them in my garage?
Please don't do that.
It would be very heavy and probably not very liquid.
And very inefficient. No, the smart money has a playbook for this. And it all comes down to understanding the difference between buying the metal and buying the machine.
The miner versus the mineral.
Right. And this is where we get into the most powerful concept in commodity investing, operational leverage.
Okay, operational leverage. Walk me through the math on this. I want to understand exactly why the miner is a different bet than just buying the metal itself.
All right. Let's imagine you own a gold mining company. To pull 1 ounce of gold out of the ground, let's say your all-in cost is $1,500.
Okay, $1,500, that's for the diesel, the workers, everything.
Everything. That cost is relatively fixed. It costs $1,500 to dig that hole, whether gold is at $2,000 or $3,000 an ounce.
Got it. Fixed cost.
So let's say the price of gold today is $2,000. Your profit is $500 an ounce. Simple enough.
2,000 minus 1,500. 500 profit.
Right. Now, let's say the price of gold goes up by just 10%. Not a huge move. It goes from 2,000 to 2,200.
Okay, a 10% gain if you just held the metal. Nice, but not life-changing.
But look at the miner's profit. Their cost is still 1,500. But now they're selling that ounce for 2,200. Their profit just jumped from $500 to $700.
Oh, I see.
Yeah.
A $200 increase on a $500 base, that's a 40% increase in profit.
Exactly. The metal went up 10%, but the miner's profit went up 40%. That is operational leverage. When the commodity price runs, the cash flow of the producers just explodes.
That sounds incredible. That sounds like the winning lottery ticket. Why wouldn't I just pour everything I have into mining stocks?
Because mining is a terrible business.
Wait. You just sold me on it. You just showed me the explosive math.
The math is beautiful. The reality of the business is brutal. This is what we call idiosyncratic risk.
Meaning things that can go wrong with that one specific company.
Exactly. Mines flood, tractors break down, workers go on strike, and the big one, the one that can wipe you out overnight, geopolitics.
Right.
You build a beautiful mine in a politically unstable country, the price of copper triples, and the government might just decide, you know what, that's our mine now.
Thanks for building the infrastructure. We'll take it from here.
Or they hike your taxes to 90%. So you could be 100% right on the macro thesis for copper, but you lose all your money because the specific miner you chose gets nationalized.
So you can lose everything, even if you were right about the big picture.
You get all the upside leverage, but you also take on all of the execution risk.
So is there a middle ground? A way to get that leverage without worrying about a flooded mine shaft or a sudden coup d'etat?
There is, and this is the preferred vehicle for the most sophisticated institutional money. It's called the royalty company.
Royalty companies. I've heard the term, but how does it actually work?
Think of it as the capital light model. A royalty company is basically a specialized financier. They don't operate mines.
So they're not miners.
Not at all. They go to a mining company that has a great discovery, but needs, say, $100 million to build the mine. The royalty company says, here's your $100 million. In exchange, you have to give us 2% of all the gold you ever produce from this mine, forever.
So they don't own the tractors.
They don't own the tractors. They don't pay for the diesel. They don't manage the workforce or deal with the environmental permits. They just have a contract that gives them a piece of the top line revenue.
They just sit back and collect checks.
The best analogy is the smart money figure in a crisp suit standing on a hill overlooking the mine. Down in the pit, the miners are sweating. They're covered in mud. They're dealing with broken equipment. The guy in the suit is just standing there holding a bucket, catching 2% of the gold nuggets as they come out.
And if the price of gold doubles?
The value of his 2% doubles. He gets the full upside from the price explosion. But if the cost of diesel doubles for the miner, or the workers strike for a 20% wage increase,
He doesn't care. That's the miner's problem.
he doesn't care. He gets the pure price exposure without the operational or cost inflation risk. It is by far the superior vehicle for playing a supercycle.
That's fascinating. It's like investing in the flow of the commodity rather than the messy operation of getting it.
Precisely. And that brings us to the big institutional picture. Because the big funds, the pensions, the endowments, they're looking at this entire landscape and they are terrified of their current positioning.
You mean the classic 60-40 portfolio? 60% stocks, 40% bonds? That's been the holy grail for 40 years. It's what every financial advisor tells you to do.
It has. And the urgent institutional strategy memos that are circulating right now are all saying the same thing.
What's that?
The 60-40 portfolio is dead.
That's a huge statement. Why is it dead?
Because its entire success was built on a world of low and falling inflation. In that world, when stocks went down, your bonds would usually go up. They acted as a hedge for each other.
A counterbalance.
Yes. But in a commodity supercycle, which is an inflationary environment by definition, that beautiful correlation completely breaks down.
Because inflation just kills bonds.
Inflation destroys bonds. If inflation is running at 5% and your bond is paying you 4%, you are losing money in real terms every single day you hold it. So your bonds go down. At the same time, inflation drives up input costs for companies, energy, materials, wages, which squeezes their profit margin. So stocks struggle.
So both sides of the 60-40 portfolio lose money at the same time.
They both go down together.
So where do these big funds go? If stocks and bonds are both bleeding, where's the safety?
The only safety is in things that cannot be printed. The structural deficit we talked about in copper and uranium, this is not some temporary glitch in the market. It is structural. It is baked in until 2030 or even longer because of those 15-year lead times.
So the smart money has to rotate.
They have to rotate. They are selling the paper assets, the high-flying tech stocks, and they are buying the supply. They're buying the hard assets that the new economy is absolutely desperate for.
It really is the revenge of the old economy.
It is, and the key takeaway for anyone listening is this. The structural deficit we've identified, that provides the floor. Even if the global economy slows down, we physically do not have the materials to build out the green energy and AI transition. That floor is set.
And the upside?
The upside is the currency crisis.
It's a lot to digest. I feel like I need to go apologize to every rock I've ever kicked. I didn't realize how important they all were.
Don't apologize to them. Just own them.
Fair enough. All right, let's wrap this up. We have covered a huge amount of ground here.
We have.
We started with that tech bull illusion, the idea that software had just eaten the world and physical constraints didn't matter anymore. But you've shown us the alligator jaw.
The scary reality that while tech investment went vertical, we starved the physical world of capital.
Creating that supply air pocket, a 15-year supply gap that we can't close quickly.
Impossible to close quickly.
And then there's the demand shock, the green paradox, where saving the planet actually requires stripping it for more metals than ever before. And AI, the new darling, is really just a massive energy vampire waiting to drain the grid.
All lit powered by copper.
And then you layer on top the monetary crisis, the government debt creating an inflation floor that just pushes everyone towards hard assets as a way to survive.
It's a perfect storm.
It is. But I want to leave our listeners with one final provocative thought to really chew on.
To hear it.
We've talked about the necessity of all this. We need the copper for the green future. But there is a huge ethical dilemma here, isn't there? We want clean energy, we want to stop burning fossil fuels, but to do that, we have to tear up massive parts of the earth to get the necessary metals. We seem to be trading one kind of environmental damage for another. Is the cost worth it?
That is the defining question for the next 20 years. It's a pragmatic trade-off. There are no easy answers. If you want the clean sky, you need the messy ground. You can't have one without the other. But from a pure investment standpoint, the market doesn't care about the philosophy. It just cares about the shortage.
And for the listener at home, just looking at their portfolio, maybe the question is even simpler than that.
It is.
If inflation really takes hold, if it hits 10%, if the dollar continues on its current path, what do you trust more?
Yeah.
Do you trust the S&P 500? Or do you trust physical gold?
The future, I think, belongs to the owners of real things, not the holders of paper promises.
That's the line right there. The question for everyone is, are you holding the paper or are you holding the rock?
The great rotation has already begun. You just don't want to be the last one holding the paper.
This has been The Deep Dive. Thanks for listening, and we'll see you on the next one.